Preparing for a PIF Saudi Arabia interview questions interview. You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work at PIF? I would link my motivation to PIF's dual role, generating attractive long-term returns and helping transform Saudi Arabia's economy. What stands out is the scale of the mandate: global investing, local sector creation, and partnerships with leading institutions. I'd emphasize that I'm interested in investment work where financial discipline matters, but the outcome also builds capabilities, jobs, and strategic industries aligned with Vision 2030. That combination makes the role commercially rigorous and nationally meaningful. While answering, focus on PIF's dual mandate, attractive long-term returns, and Saudi economic transformation. Connect your motivation to Vision 2030, sector creation, global exposure, and disciplined institutional investing. Question 2. How would you describe PIF's mandate and its connection to Vision 2030? PIF is not just a passive pool of capital, it is a sovereign investor with a development mandate. I would describe its role as deploying capital globally and domestically to diversify the Saudi economy, deepen priority sectors, and generate sustainable returns. Vision 2030 influences allocation toward areas like tourism, entertainment, technology, renewables, logistics, and industrial localization. The key is balancing commercial underwriting with measurable strategic impact for the kingdom. Make sure to cover sovereign wealth fund objectives, economic diversification, local sector development, global capital deployment, and the need to balance financial returns with strategic national priorities. Question 3. Walk me through how you would evaluate a potential investment opportunity for PIF. I would start with the investment thesis: why this asset, why now, and why PIF is the right owner or partner. Then I'd assess market growth, competitive advantages, unit economics, management quality, valuation, and downside risks. For PIF, I'd also test strategic fit. Does it support localization, capability building, or a priority sector? Finally, I frame the recommendation around expected return, key sensitivities, risk mitigants, and value creation levers. In your answer, talk about investment thesis, market size, competitive position, financial performance, valuation, downside risks, strategic fit, governance, exit options, and how findings would be summarized for an investment committee. Question 4. How would you build a DCF valuation for an infrastructure or long-term strategic asset? For a long-term asset, I'd focus heavily on cash flow visibility. I'd forecast revenue drivers, operating margins, maintenance and growth CapEx, working capital, taxes, and free cash flow. The discount rate should reflect asset risk, leverage, country exposure, and contract quality. Terminal value is important, but I'd avoid letting it dominate the valuation. I'd run sensitivities around utilization, tariffs, inflation, CapEx overruns, and exit multiple, because small assumption changes can materially affect value. Be sure to mention forecast drivers, revenue visibility, CapEx, working capital, terminal value, discount rate selection, scenario analysis, and why long-duration assets require careful sensitivity testing. Question 5. What is the difference between a direct investment, a fund investment, and a co-investment? A direct investment means PIF invests straight into a company or asset and has more control, governance rights, and responsibility for due diligence. A fund investment gives exposure through an external manager, offering diversification and manager expertise, but with fees and less control. A co-investment sits between the two, investing alongside a sponsor in a specific deal, often with lower fees. For PIF, the right route depends on strategic importance, internal capability, and desired governance. While answering, compare control, economics, due diligence depth, fee burden, diversification, governance rights, execution speed, and how each route may suit a sovereign wealth fund like PIF. Question 6. How should PIF think about investments that have strategic value but lower near-term financial returns? I would not treat strategic value as a substitute for investment discipline. The right approach is to quantify both sides, expected financial return and strategic benefits such as job creation, supply chain localization, technology transfer, or tourism growth. If near-term returns are lower, the case must show clear long-term value, milestones, and downside protections. I'd recommend phased funding, strict KPIs, and governance triggers, so capital is released only when strategic and financial objectives remain credible. Make sure to cover risk-adjusted returns, measurable strategic benefits, subsidy avoidance, opportunity cost, phased capital deployment, governance discipline, and the importance of not confusing national impact with weak underwriting. Question 7. If asked to develop an investment thesis for a priority sector in Saudi Arabia, how would you approach it? I'd begin with the sector's link to Vision 2030 and then test the commercial fundamentals. For example, in logistics, I'd analyze trade flows, port capacity, e-commerce penetration, industrial zones, and Saudi Arabia's geographic advantage. Then I'd identify gaps where capital can create platforms, not just standalone assets. The thesis becomes investable only if there is strong demand, capable operators, clear regulation, realistic returns, and a path to scale or exit. In your answer, discuss sector selection, demand drivers, policy support, competitive gaps, localization potential, capital intensity, partnerships, expected returns, and what evidence would make the thesis investable. Question 8. How would you value a private company when there are limited comparable companies? When comps are limited, I would triangulate rather than rely on one method. A DCF can capture company-specific growth and margins, but the assumptions must be stress-tested. Precedent transactions may help, even from adjacent markets, if adjusted for size, growth, and risk. I'd also look at industry-specific metrics, replacement cost, and downside liquidation value where relevant. For a private company, I'd apply judgment for illiquidity, control rights, governance quality, and exit uncertainty. Be sure to mention triangulation across DCF, precedent transactions, industry metrics, replacement cost, scenario analysis, and why private company valuation requires extra judgment around liquidity and governance risk. Question 9. What red flags would you look for during due diligence on a potential investment? The biggest red flags are issues that change either cash flow quality or control of risk. Financially, I'd look for aggressive revenue recognition, weak cash conversion, hidden liabilities, and customer concentration. Commercially, I'd test whether growth depends on unrealistic pricing or market share gains. I'd also review litigation, related party transactions, governance weaknesses, CapEx needs, and ESG exposure. Depending on severity, the response could be price reduction, warranties, covenants, staged investment, or walking away. While answering, focus on financial, commercial, legal, operational, governance, ESG, and management red flags. Link each red flag to valuation adjustment, deal protection, or a decision not to proceed. Question 10. How would you monitor an investment after closing? Post-close monitoring should be structured, not reactive. I'd track financial KPIs like revenue, EBITDA, cash conversion, CapEx, leverage, and budget variance, alongside operating metrics specific to the asset. For PIF, I'd also monitor strategic KPIs such as job creation, localization, technology transfer, or sector development. Regular board packs, management meetings, and risk dashboards help identify issues early. If performance slips, I'd focus on root causes and corrective actions, not just reporting variance. Make sure to cover portfolio KPIs, board reporting, budget versus actuals, value creation plans, liquidity, covenant compliance, ESG or strategic impact metrics, and escalation when performance deviates. Question 11. What are the main risks PIF must manage as a large sovereign wealth fund? A fund like PIF must manage risks at both portfolio and deal level. Market risk affects listed assets and valuations, while liquidity risk matters because many strategic investments are long duration. Concentration risk can arise by sector, geography, or theme. Currency and geopolitical exposures matter in global investing. Domestically, execution risk is critical because large projects can face delays, cost overruns, or demand uncertainty. Strong governance, diversification, stress testing, and clear accountability are essential. In your answer, include market risk, liquidity risk, concentration risk, currency exposure, geopolitical risk, execution risk, governance risk, and reputational risk across domestic and global investments. Question 12. What would you include in an investment committee memo for PIF? An investment committee memo should make the decision easy to evaluate. I'd start with the recommendation, required capital, expected return, and strategic rationale. Then I'd present the business overview, market analysis, financial model, valuation, diligence findings, key risks, and mitigants. For PIF, I'd include strategic contribution to Vision 2030, governance rights, localization impact, and partner quality. The memo should end with sensitivities, downside case, approval conditions, and the specific decision requested. Be sure to mention executive summary, investment thesis, strategic rationale, valuation, return analysis, risks, diligence findings, governance terms, exit routes, sensitivities, and a clear recommendation. Question 13. How would you prioritize between multiple sectors competing for PIF capital? I'd use a scoring framework rather than intuition. First, assess strategic relevance. Does the sector support diversification, employment, localization, or national competitiveness? Second, evaluate commercial attractiveness through market size, growth, margins, and exit potential. Third, test execution readiness, including regulation, talent, partners, and infrastructure. I'd also consider capital intensity and whether PIF's involvement crowds in private capital. The best sectors are those where strategic impact and risk-adjusted return reinforce each other. While answering, focus on return potential, strategic relevance, execution readiness, capital intensity, private sector participation, ecosystem effects, risk profile, and whether PIF has an advantage as sponsor or investor. Question 14. A target company has strong growth but weak governance. How would you handle the investment recommendation? I would not reject it automatically, but I would treat governance as a core underwriting issue. Strong growth can be destroyed by poor controls, related party transactions, weak reporting, or misaligned management incentives. I'd identify the specific gaps and decide whether they are fixable. If they are, I'd recommend protections such as board rights, audit controls, reserved matters, staged funding, reporting upgrades, and management incentives. If governance cannot be improved, the risk may outweigh the growth story. Make sure to cover governance as a value and risk driver, due diligence, control rights, board composition, reporting requirements, staged capital, valuation discount, and conditions precedent before closing. Question 15. Tell me about a time you worked with senior stakeholders under pressure. How would that translate to PIF? I'd choose an example where the stakes were high and the timeline was tight. The key is to show. In your answer, use a concise star structure. Emphasize judgment, communication, ownership, analytical discipline, and stakeholder management. Connect the example to PIF's high-visibility, multi-stakeholder investment environment. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.